Friday, Melonheads. We made it. Oh my goodness, when I got off the plane from Dallas on Sunday night and I saw what oil futures were doing, I didn't know if we were going to make it till Friday. Who knows, man? Oil hit, $137 a barrel or something Sunday night? Luckily, we took a little breather in the commodities super cycle this week. Things settled down a little bit. Thank God. Prices that go vertical cannot go vertical forever. They inevitably come back down, or at the very least, they stop and catch their breath. My guess is right now, they're just catching their breath. I don't think this commodity run is done. And so I made a couple of trades this week to that effect. Took profits where I could, pulled out a little bit of cost basis, and then put a little bit more in play. And how about that move we saw in nickel this week? Wow, and what is the lesson learned, folks? When things get difficult for the big guys change the rules to screw us. And that's exactly what they did in nickel, just like they did in GME and AMC, and just like they did with silver, and who knows when they're going to do it next. But they can only get away with that for so long, because the more of that BS that they pull, the less sway they hold over markets. People will not take that forever. Other parallel markets are going to develop and take away their market share. So LME, you can only play that card so many times. We saw what you did this week, and it stinks. It smells. You can't keep doing it forever. Anyway, hello everybody in the chats there. I see Nicole Post. I see Mr. Mike Binder, Neil Hahn. Of course, Neil, you're here within 30 seconds of posting the thing. Mr. Cole Marsh, Mish, the moderator, is in the chat. Onsite Trav, how you doing, brother? Good to see you in the chat. Everybody, check out Onsite Trav's channel while you're at it, by the way. He does some excellent stuff, some excellent market commentary, talking about his food forest. I love watching the progress on your barn dominium, sir. So congratulations on that. Keep up the awesome stuff, Onsite Trav. And no, I wish I could say I was in nickel, Trav. I was not in nickel. Can't take credit for that one. I'd love to be one of those guys on YouTube who every time something big happens, just be like, yeah, I was in that one. Didn't I tell you about that? Remember? You know, that person who always magically made the trade after the fact, but never told you beforehand. Yeah, those guys are out there. There's a lot of them. That's not me. I was not in nickel. I would love to have been in nickel, although I was not. Also, hi, Mom. Hi, Dad. Love you guys. Thanks for watching. But, you know, let's just jump right into nickel, man, because so what happened is there's this guy in China, all right? We're going to call him Mr. Alfred Hole, or A-Hole for short, all right? And Mr. A-Hole over in China, he was massively short nickel, like billions short nickel. And he calls himself the big shot, not because he's tough or anything, just because he's A-Hole. And, well, he got margin called because his big short position in nickel, he owns a nickel producing company, but he had this massive short in nickel, and they margin called him, and he couldn't pay up. And so the price started running, and that counterparty risk, when you're short something, the brokerage you place the deal with, they take on risk on your behalf. All right, and so they margin called him. They said, your shorts are now so far underwater, we're starting to have doubts about whether or not you can pay us. We want you to pay us right now. He said no. So that means those brokerages are now on the hook to cover his shorts. And they started doing that. They started covering those shorts, and the price went up, 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 and it went up like 250% in a matter of hours. And now the brokerage is at risk, and the brokerage is saying, maybe we can't pay because there's not enough nickel in the world for us to buy to cover A-Hole's shorts because, well, Russian nickel is now off the market because of the thing with SWIFT. And finally, the London Metal Exchange said, you know what? The rich guys are starting to lose too much money. Turn it off. Turn this all off. Shut it down. Everybody go home. We're done here. Turn it off. Because rich guys don't like losing money. Rich guys only like it when you lose money. And when I lose money. They don't like it when they lose money. They change the rules when they lose money. So they turned it all off. Not only did they turn it off, this is the best thing. I love this. Man, it must be great to be these guys. They didn't just turn it off. They canceled trades. And if that doesn't sound right to you, or if that smells wrong to you, don't worry, you're not wrong. They canceled trades. So I want you to imagine you bought a stock at 50, okay? And that stock goes to 100. And you might think, wow, I doubled my money. That's great. But then you go to sell And Robinhood or TD Ameritrade says, oh, we canceled your trade. Here's your 50 back. What? Excuse me? Yeah, that's what they did. You see, Mr. A-hole was losing too much money for A-hole and the big guys, and so they canceled the trades. All they did was, oh no, we're taking back your nickel futures. Here's what you paid back for them. We're canceling the trades. We're not giving you fair market value for what you bought a few hours ago. Nope, we're just canceling the trades. It's like it never happened. Remember when we sold you something that's now worth way more than you paid us for? We're taking it back and we're not giving you anything for it. We're just going to give you your original money back. Can't do that forever, folks. The more these muckety mucks do this kind of crap, the fewer people are going to be willing to play in these markets. And LME, I tell you, you lost a lot of street cred with average investors. And if you're worried about these parallel exchanges popping up in Dubai or in Shanghai, well, can you blame them? Can you blame your clients for not wanting to do business with you anymore? Because you're a piece of... Yeah, you are. So I wouldn't be doing any business with LME either. So that's what happened in nickel. I've been talking about this scenario, this very scenario playing out in silver for the better part of a year and a half, but it happened in nickel, of all things. Nickel. Yeah. So, yeah, folks, that's what played out in nickel markets. I could not believe it when I saw that. So we're going to shrink my big fat melon of a head right now. And let's just take a look at where the markets are right now. It's at 322. We are, about 38 minutes away from the close. And right now, it looks like markets are down, but not nearly as much as they should be down. S&P down about 30 points. Dow down 62. NASDAQ having a rough day, down 1.5%. And look, folks, the writing is on the wall about the big tech stocks. Inflation is exploding higher. That 7.9% read we got in inflation this week has nothing to do with this massive spike in commodities. None of that was reflected in this inflation print because all this big commodity spike happened in March. It didn't happen in February. So we're looking at a much, much higher CPI print next month. Get out of big tech stocks. I'm not a financial advisor. This isn't financial advice. Do your own research, your own DD. Arrive at a decision right for you based on your unique situation. But I would not be touching these high valuation, high multiple, big tech, Cathie Wood garbage. Not with my worst enemy's money right now. I just wouldn't. They're way too overvalued as it is. And in a hyperinflationary environment, these things, they're going down. So not a big fan of the NASDAQ, although I do not quite have the cojones to go short the NASDAQ just yet because this market is still very much irrational. So I'm not saying there is zero upside to the NASDAQ, just that I'm not going to go chasing it. All right, let's take a look at commodity markets because that's really the recurring theme that we saw this week was the commodities are taking a breather. We had that big run late last week and early in this week, and now it seems like everything is slowing down. Gold's down a little bit today, down $11 at 1989. We dipped below that it went down to about 1965 today and held that level, came back above. 1980 is the level I'm watching. I like that we're still above that. I think gold, not worried too much about the short term. Long term gold is going much, much higher. Also, don't count the Russians out. I don't know what they're up to. I know they own a lot of gold, and I know they need to do something to support their currency, and I know they have a lot of gold mines in Russia. So we have not heard the last from Mr. Putin when it comes to gold markets. Same goes for silver. Silver holding above $26 a barrel. I actually took delivery of some physical this week. Was very happy to get that coming in. If you're planning on buying physical gold and silver, folks, don't sit around and wait until a nickel situation happens in silver markets, because then silver becomes unobtainium. You won't be able to get it. So I dollar cost average into gold and silver, into physical. I don't try to time markets. I just buy a little bit on a regular basis. If it's your plan to wait and pile in right at the last minute, folks, there's a lot of people with that same plan, and the premiums are going to spike if you can even get any. You're not going to be able to get your hands on it. So, again, not financial advice, but I would not be sitting around and waiting. Also, I just want to send a shout out to Mr. Jim Lewis over at Wall Street Silver, who gave me this in Dallas. Can you focus in on that? That is a generic 1 ounce round with Troy on it. It says this is the way on the front, And then on the back, it's got the gorilla holding the rocket ship, which is clearly a moon-bound rocket ship. And these were made, I believe these were made by SD Bullion, or they were commissioned by SD Bullion. So thank you very much, Jim Lewis, for this wonderful ounce, which is going to reside in my pocket for a little while. It's going to be my pocket silver. But I've been showing everybody my new Wall Street Silver generic 1 ounce. Those are available at SD Bullion. And by the way, folks, if you're not already a member of the Wall Street Silver group on Reddit, what are you waiting for? There are big things coming in precious metal markets this year, and you will see it in that Reddit forum first. There are some serious wrinkle brain dudes in that group who post some fantastic stuff. That's actually, this channel was born in Wall Street Silver. If you didn't know that, that's how I got my start. Just because I got a big mouth and I was ranting into my phone about inflation one day, and somebody said, "Hey, Jack, you should have a YouTube channel." I said, "Okay." So here I am. Here we are. But I want to point to this. I saw this in the Wall Street Silver Reddit today. Shout out to my man, Ditch the Deep State, who is one of those guys who just does excellent, fantastic DD in the Wall Street Silver group. And all right, this chart, there's some serious spaghetti going on in this chart. If you've never seen this before, if you're a Wall Street Silver member, you've probably seen this chart before. But each one of these, this is the number of new silver contracts issued on the COMEX after the first notice of delivery, or after the first day's delivery notice. All right, so new contracts issued after first delivery notice tend to be contracts that get delivered on, right? These are not contracts that are probably going to get rolled over or settled in cash. The only reason you would issue a contract after first notice of delivery is if you intend to take possession of the silver. And you can see these previous months, all these other lines showing previous months and years, they tend to follow a pretty steady pattern. Sometimes we get these spikes right before, 20 days after or whatever. But you can see this goes all the way back to the silver squeeze months. But look at this line in red. Look at all the new silver contracts that have been issued this week. I mean, it ran out of room on the chart. 1,738 contracts. I didn't do the math ahead of time. That's 5,000 ounces per contract. 1,738 times 5,000 ounces per contract. That's 8.7 million ounces. That's probably going to be delivered on. All right, and remember, there's only about, 85 million ounces in the whole registered category on the COMEX? So those contracts right there represent 10% of the float in the silver market. And they're still climbing every day. Something's brewing in precious metal markets, folks. Now, I don't know, are they going to pull a nickel? Are they just going to say, sorry, we're losing too much money. We're going to turn everything off again. Shut it down. Turn it off. Everybody go home. Sorry, silverbacks are making too much money. Turn it off. JP Morgan's not allowed to lose money. We changed the rules. Are they going to do that again? Maybe. Are they going to get away with it? Maybe. Probably. Is the CFTC going to do anything about it if they try? Definitely not. They're in on it. All I'm saying, folks, is we may be looking at some kind of a repeat of January, February 2021 right now. That's what looks like could be brewing in silver markets right now. All right. Or it could be a repeat of 2008, 2009, and the run that silver had over those few years. All I can tell you is silver is probably the single most undervalued asset in the world. I don't think anything comes close to being as undervalued as silver between its monetary value and its industrial value and the supply of it, and then factor in the ridiculous mountain of paper that has been stacked on top of the actually very limited physical supply that's out there. Silver has all the makings of a nickel situation. And when I see a chart like this, and again, shout out to Ditch the Deep State and to Jim Lewis, who runs the Wall Street Silver Group, and Ivan, who founded it, and all those guys that are over there. Keep your eye on this silver market, folks. There's something happening there. Again, I don't know enough about the mechanics of the COMEX. I mean, you're probably better off with a guy like Rob Keens over at Gold Silver Pros. If you want to really know the ins and outs of how this works, and check out Rafi Farber's work, what he did trying to actually take delivery on one of these contracts, and all the ridiculous shenanigans that he went through, and how they just refused to give him his silver no matter how many different ways he asked and how many pretty pleases and cherries on top. He just could not get his silver away from these guys. So all I can tell you is something doesn't smell right in this COMEX right now, and COMEX is ripe for a failure. So keep your eye on that silver market. All right. Now, real quick, I just want to look. I saw some questions early before we started from Nicole Post asking about oil markets. All right. And Nicole, I think you were asking something along the lines of, are we going to 100 again in oil before we go higher? Uh, this is looking at oil. This is about a 6-month chart of oil. 100 is right about where my cursor is right now. Are we going that low? Maybe. Maybe not. But respectfully, I think that's probably the wrong question to ask, Nicole. Not that that's not a big difference. I think oil is going to pause here. I think all the commodities are just consolidating. They're catching their breath. They ran really hard. I think they're going to trade sideways for a little while. I don't know how long. But, I mean, after a run like they've had, they just have to catch their breath. They got so overbought. Now, I think in the long run, though, they are going significantly, significantly higher. I think we see 150 this year. If things get worse geopolitically, if this tit for tat economically with the Russians continues, if the Iranians get involved and we see some problem in the Strait of Hormuz, then the difference between 100 and 109 is going to be trivial compared to where oil's heading from there. And again, a lot of things need to go right for that not to happen. I mean, right now there's just so many things going wrong that we'd need to have like this abrupt pivot towards world peace in order for that not to happen. And I'd love, that'd be a great problem to have, right? I'd love for that to happen. I just don't think that's going to happen. I mean, the leaders in the East are belligerent, power-hungry a-holes. The leaders in the West are weaklings and idiots, and I just don't see them getting their acts together. I don't. So, again, I'm not too worried about the next couple of days. I think we're going to pause here. I can tell you what I did today. I took a little bit of profit in my ERX. ERX is this one, the Direction 2X Energy. Now, I've been trading in ERX and XLE, and these are ETFs. They hold pretty much the same stocks, right? Chevron and ExxonMobil is like 50% of both funds. ERX is levered. XLE is a 1-for-1. So I sold a little bit of my Direction. I'm down to about 1/3 of my original position in ERX now. And what I did was I pulled out my cost basis in that, and I rolled the profits into call options in XLE, which is the non-levered ETF. And these are at a slightly higher strike, and they're further out. Because the reason why is if we're going to be in this sideways trading pattern for a while, and I think eventually we move higher, I don't want to be sitting in call options in this levered ERX fund because the levered funds are always losing value over time because of that leverage and that time element. You've got decay, plus your options have theta decay. So I didn't want to sit in this 2X levered fund while the oil chart is consolidating and it's in this, what I think is a bull flag pattern is developing. I don't know how long it's going to be in it. But at the same time, I wanted to maintain my upside exposure. So I pulled out my cost basis and then I rolled the profits into this XLE where the upside isn't as big, but at the same time, I'm not going to eat that decay like I would in the ERX. So that's my strategy right now. I think we're going to trade sideways for a little while, but just in case, I left a little bit on the table. I hope that makes sense. That was an excellent question, Nicole. And don't give me too much credit for market timing, though, because I'm not that good at this. I'm really not. I'm an okay investor. Okay, there are much better than me out there. Trust me, guys. All right. The other thing I wanted to mention, and it looks like that order filled, is because I took profits in Cheniere Energy last week. I still have the majority of my position, but I sold about a quarter of my position last week at 135. And I guess while I've been talking here, I put in an order today to buy those back at 130. And it looks like that hit because we're now in the 129s here. So I have bought back my stake in Cheniere Energy because, again, I think this is a much longer-term play. I think the global energy market has shifted with Germany now talking about building more LNG import terminals. I think a lot of that business that was going to go through the Nord Stream pipelines is now going to Cheniere. And I also think it's just a matter of time, regardless of the political headwinds faced in this country, how much longer can we sit on an ocean of natural gas in the United States while the rest of the world freezes and starves to death because of this geopolitical tension that is killing energy markets, driving up power prices, killing fertilizer production, killing crop yields, and eventually killing people. How much longer can the United States sit here and say we're not going to build pipelines, we're not going to tap our own natural gas? All right? Are we going to sit there and watch people suffer and die so we can feel good about ourselves for fighting climate change? No. No, sooner or later that gas is coming out of the ground here in the States because the world desperately needs it. So I'm keeping this Cheniere Energy position long term. I think that's a safe play, and it's literally a matter of life and death, folks. We need this gas. The world needs this gas now. So I think it's coming. Another thing I've been talking a lot about was the corn trade. Let's see what the commodities are doing right now, because we've got a big move down in wheat this week, but corn really hasn't moved that much. Corn actually headed a little higher this week. And it looks like wheat got a little bit of a bounce while I was talking. Again, this is looking at the corn chart. This is the corn ETF that I own call options in. You can see we have this little flag pattern forming here. Should we draw some lines? Let's draw some lines on the chart. Here's what I see kind of playing out right now. And again, I'm just very roughly drawing this pattern. And I see this in quite a few of these commodity plays right now. I see this little bull flag pattern developing where, we're going to get real sloppy here. Let's see. Where's my doodle? I think we're probably going to trade around like this before we eventually break out, retest, and move much, much higher. And that's my very sloppy bull flag pattern with our arrow to the upside. Now, that may take months to play out, or that may play out in days. Again, that's why I have moved some of my, at least in the oil commodity trade, where I got out of some of those levered funds and bought some of the non-levered funds that have the same underlying, just so I don't lose as much value while that pattern's playing out. I think corn and I think wheat are going to do something similar here for the time being. Now, again, the corn trade, this was really about the fertilizer story, okay? I started talking about the corn trade back in October, and that was when I saw fertilizer prices spiking and I saw the energy crisis in Europe. The prospect of war in Eastern Europe was not the main underlying thesis with the corn trade. That was just one of those sidebars, I guess, if you will. But that has now amplified the effect of the energy crisis on the fertilizer story. I'm telling you, Europe is not going to be making any fertilizer anytime soon, not with natural gas prices the way they are. Belarus is not going to ship any fertilizer. Russia and China are not going to ship any fertilizer. So if the world needs fertilizer, they're going to have to get it from the United States. We're going to be the only place to get nitrogen fertilizer made because we're the only ones that have the gas. And again, if we're sitting here telling ourselves we're good people for not pumping the gas, well, that means other people are starving to death. I don't think that's going to last very long. So we're going to have to pump more gas. We're going to have to make more fertilizer. The world needs it or people starve to death. All right, all that means corn prices, wheat prices heading much, much higher. And by the way, I've been talking about this a lot on this station, folks. What's happening in global food markets, all right? I need you to understand, I cannot say this enough. This is next year's food. It has already gotten more expensive. It just hasn't hit the supermarket yet, all right? Fertilizer is like molecule for molecule what we're going to eat next year. And fertilizer, the price has tripled or probably quadrupled by now. I haven't looked at fertilizer prices in a couple of days, all right? So if the very same molecules that we're going to eat next year are 4 times as expensive now, what does that tell you about what the price of food is going to be when that time finally gets here? Don't sit around and wait. Get yourself a supply of non-perishable food. Have it in the shelf just in case. If I'm wrong, eat it next year, and all you did was hedge yourself against inflation. All right. If I'm right, be glad you did. All right. And I did that video about, I was kind of a goofball in that video, making jokes about buying rice and beans and trying to keep the budget low for under $100 a month for a family of 4. But it wasn't an accident, the timing of that. I see what's going on in the food markets. And man, did you see the video that Sage News put out yesterday about other countries not exporting fertilizer, not exporting food? Again, that's something we've been talking about for a while here on this channel, the breakdown in globalism. Well, Sage follows, he follows logistics. I mean, he does the supply chain. That's his thing. And he's seeing it now. He's seeing food exporting countries are hoarding. Countries are turning into preppers. They're hoarding food and fertilizer. That means the have-nots are going to starve. All right. And now it's not just me theorizing about it. Now Sage is covering it because it's happening in real time. We've had, I think it was Hungary, just said last week that they're going to put curbs on food exports. All right. It's another food exporting country that's taking their crops off the market. It means the countries that can't grow their own food are going to have to bid up the prices even higher if they want to get some. I'm really worried about what I see in food markets. I'm worried about what that means for people, for society, I mean, and all the bad things that comes along with higher food prices. Trying not to get too fuddy here, folks. I'm trying not to get too tinfoil hatty, but this I wouldn't mind being wrong about this one. Let's put it that way. All right, let's take a look back here, see what markets are doing. We are now 19 minutes from the close. S&P is down 44 points, gaining a little bit of steam in this sell-off in the close. Dow down 156. NASDAQ's now down 242, heading lower. Oil looks like oil's probably done for the day at about 109, and gold is holding steady. Let's look at the commodities. Not a lot happening in commodities. Silver's down a little bit. Gold's down about $11. Platinum and palladium took a breather this month. The price of palladium has been running like crazy. Platinum as well. And let's see, what are the grains doing? Wheat's now up $20 and corn is up 7. So we are going to keep a very close eye on those stories. Really, again, my investment strategy, it remains focused on eat and heat. Food, energy, and by extension, precious metals. I think that's where you want to be, folks. I don't see any need to get too fancy with tech stocks, with cloud stocks, with electric cars. All right. Look, there's people in the news that are talking about electric cars right now. Who are they kidding? When people can't afford to eat, they're not going to be buying a $60,000 electric car. All right. And who has been pounding the table about pumping more gas, about developing our commodities infrastructure? Who? Elon Musk has been the one on TV and on Twitter pounding the table about our need to develop our own domestic supplies of these vital materials. Why? Because he knows if inflation gets any worse, nobody's going to buy his expensive cars anymore. It's not because he thinks this is good for Tesla's business. So I would not be messing around. I don't see any need to get into the NASDAQ. Apple's not going to sell many iPhones in China, not with the Chinese real estate collapsing. And by the way, speaking of the Chinese real estate market, I'm not going to get too far into it because I just finished up recording a video. It's going to come out in a few hours about the Chinese real estate market and crypto markets. There's a couple of stories came out today. Keep your eye on that one. We haven't talked a lot about Evergrande, but that's not because that story has gone away. That's not because that one is over and suddenly China's out of it. It's just because there hasn't been that many bond maturities for the last month or two. That's all about to change over the next few days. So China will be making its way back into the headlines very soon. And with all this new stress in the banking system being caused by the Russians being booted from SWIFT and all of the defaults and all the counterparty risk and all the default provisions that are about to get triggered by this, what is that going to do to banks that are already stressed by the collapse of the Chinese real estate market? I don't think this risk is behind us. I don't think just because the world financially has not ended in the last few days doesn't mean it's not going to. I just think it's taken a little longer. And meanwhile, the markets just keep heading up. They just keep ignoring it. It's like anything short of absolute Ragnarok, anything shy of doomsday, and markets are up for the day. All right, it can't last forever. And again, I know there's a lot of channels out there are talking about bank stocks, saying with the rate hikes coming and the rising interest rate environment, I get the conventional wisdom that bank stocks do well in a rising rate environment. I get that. But I don't think that is taking into account the counterparty risk that this over-leveraged banking system is now facing with pretty much anything coming out of Russia is going to go to zero within 30 days. With everything that's happening in China, with as levered up as the European banks are, with all the defaults that are coming out of Europe, because people can barely afford to fill their gas tank in Europe now and to heat their house in Europe now you're going to have a lot of defaults, a lot of smaller companies going belly up because they can't afford to eat these higher fuel prices. Watch those European banks. Watch out for those European banks. I talked a lot about Credit Suisse on Tuesday, about what's going on, how they were caught telling their hedge funds to shred documents related to loans written against Russian oligarchs' assets. Whoops. Got caught doing that, didn't they? How Credit Suisse just had that big, what was it? Not money laundering scandal. They were taking money from dictators and war criminals and drug dealers, and they got caught doing that. And then Credit Suisse started margin calling their clients. Anybody who was holding loans written against Russian assets got margin called. Something's brewing at Credit Suisse. Those Russian banks. There's a lot of things in the global financial system, in this big complex machine with all these moving parts. There's a lot of things that are starting to make noise. Right? I don't know what's going to break first. Something's going to break. All right. And I think it's about time to take up the chart, isn't it? Should we bring out the chart? By the way, Cole Marsh is saying ECB is scared, European Central Bank. Yes, they are. They left their rate hike, or they did not hike rates yesterday. They left their rates unchanged. So watch those European banks. And I just want to remind you of the chart. We haven't looked at the chart in a while. All right, this pain tolerance threshold for the U.S. economy. This is the yield on the U.S. 10-year Treasury. Now, I haven't talked a lot about this because we came back from the brink. We were pushing that 2.2 threshold right before the Russian invasion started. We were all the way up here, about 2.05. Well, look where we're at right now, folks. We're back over 2% on the 10-year Treasury. Keep your eye on that 10-year Treasury. This chart, you go all the way back to 1987. Every time we've crossed above this purple line, every time we've touched it, there has been some kind of major financial event. Black Monday, 1987, the largest one-day stock market collapse in history. The 1994 bond market massacre that started in Japan. The dot-com bubble bursting in 2000. The global financial crisis, 2007, 2008. The Powell pivot in the fall of 2018, which eventually led to repo madness and the pandemic. And now here we are, pushing very close back to that line right before the Fed hikes rates. Remember, the Fed's going to hike next week. That's a quarter-point rate hike. And at this rate, the yield curve might invert before that even happens next week. So that yield curve has been getting awful flat lately. And I see Dumb Money is there in the chat saying the MMMRI is at 154 now, high risk. That's right. I haven't looked at the MMMRI in a while. Let's bring that up. Now, there's two different versions of the MMMRI that are out there that use different debt-to-GDP figures. There is this one that's on this Manorino MarketRiskIndicator.com website that shows it's at 154. And then there was Mr. Harry Dan 2 who made the chart. And his is it's a little bit higher because he uses a higher debt-to-GDP ratio. He uses the one from the U.S. debt clock. So they're both out there. There's different versions of it. I've been using 1.3 in my calculations for the debt-to-GDP ratio, even though we don't really have that data in real time because both numbers are constantly in flux. But I'm leaning towards this one around 154, which is in the high-risk range, still well below the extreme risk category. And while we're here, the original Manorino's original masterpiece, the MMRI, is at 123 in the moderate risk range. So we're going to keep an eye on this one. Again, those 10-year yields, they're creeping back up. Keep your eye on those. All right, and next week when that rate hike happens, it's not going to be an instantaneous break when we go above this line, right? It's not a switch that's going to flip. That just means that the conditions are present for a big market accident. And with all this stuff going on in Russia and China and European banks and now rate hikes, let's just say I'm not going to be getting into any NASDAQ stuff anytime soon. Hello, Uncommon Sense. There's my man Chad is in the chat. I met Mr. Uncommon Sense when I was in Dallas. It's good to see you, brother. Thank you for joining the live stream. There's Mike Binder also. He says you can actually short tethers, USDT versus USD. You know, Mike, you gave away my video I got coming out in the next couple of hours. I'll probably post that one in about 2 hours. Thank you for sending me those links today. Mike Bender sent me a couple of charts and a couple of stories. Mike's one of those guys that's always feeding me information on Twitter And thank you, Mike, for everything you do for the channel. I really appreciate that, brother. And like I said earlier, there's something big coming in crypto markets, and it's going to start in China. All right, we are now 10 minutes away from the close. Let's see what we've got. Is this sell-off gaining steam? Looks like it. S&P is now down almost 50. Dow down 188. NASDAQ now down 260. So the markets are selling off a little bit in the close. That's probably traders don't want to be holding going into the weekend, because a lot can happen over the weekend in this world, can it? I've got It's Fifth Son. It's Fifth Son? It's Fifth Son? Is that the name of it? It says 2.25 go boom. That's interesting. Is that on the 10-year? Because I was at 2.2 go boom. So 2.25, that's right about the same neighborhood. We're not that far off, sir. And let's see what some of these other ones are doing. Looks like LNG lost a little bit more. ERX also down a little bit, down 71 today. XLE, again, the commodities trade, folks, it's just taking a breather. I don't think this story is over. I think all the commodities are going much, much higher in the medium term. Also, I just want to mention, I'm going to be live streaming the Powell's press conference. I believe it's on Wednesday coming up this week. Let me double check that. Let me bring that up on Google and tell you when exactly it is. When is Powell's press conference? I'm going to be live streaming that after the rate hike, where we can hear all about it. Oh, the Federal Reserve. Their website is terrible. I don't know when it is. I think it's Wednesday. We'll say Wednesday. Look for my post later in the week. But we're going to live stream that one. We're going to see in real time how gold markets, how the stock market, how treasury markets react to what Powell says. Powell's been very, very hawkish lately. With each press conference, he's taken a markedly more hawkish tone. Although right now, I think all the pressure is still on Powell to be very hawkish, right? We're just coming off a 7.9% inflation number. Everybody's talking about the price of gas, right? Like if you're in one of those awkward moments in the elevator with some stranger or say some coworker that you don't really like, but you're in the elevator with them and you can't just sit there quietly and you have to talk to this person. If you absolutely must, just talk about gas prices. You can pass the time by talking about how expensive gasoline is. Everybody will be like, oh yeah, gasoline, well, it's really expensive. I filled up my tank the other day, it was this much. It's like weather. You know, it's a substitute for weather. It's the lowest form of conversation available right now is talking about gas prices. So keep that one in the back of your mind. If you need to fill an awkward silence, just be like, gas prices, what's up with that? Because everybody is talking about it. Everybody's thinking about gas. And so, therefore, Powell has immense political pressure on him to get gas prices under control. And, you know, the folks in the White House, Miss Psaki, she's tired of getting asked about gas. So they want gas prices to come down. And look, I guess they think rate hikes are going to lower gas prices. Got news for you, folks. Rate hikes are not going to bring gas prices down. You know what brings gas prices down? More gas. Make more gasoline. Let someone build a refinery. I just throw them out there. When's the last time we built a refinery in the United States? Why are we still running 70-year-old oil refineries? Maybe we could build a new one. Maybe we could drill our own oil. Maybe we could drill our own gas. Instead of buying it from overseas and then spending all the energy and emitting all the carbon to ship it across the ocean only to do the same thing with it here, and then congratulating ourselves for taking care of the environment, which, by the way, it's actually a net negative for the environment when you ship it all the way across the ocean. I just throw them out there. You do what you want with them. But if you really want to get fuel prices down, make more fuel. Supply and demand. All right? Rate hikes, not going to bring fuel prices down. All right? But this way they can tell themselves they're fighting inflation with these rate hikes. But look, inflation's 7.9% if you believe the surface number. Really, it's 15 or 16% if you look at shadow stats and what they're saying about inflation numbers. A quarter-point rate hike is not going to stop 15% inflation. It's just not. Inflation's going to keep getting worse for quite a while. The only way to stop inflation is to pull a Paul Volcker, which is going to just absolutely like slash and burn the whole global economy. They're not going to do that either. So they're going to fight inflation just enough to say we tried, And then when the economy crashes, they'll turn the printers back on and they'll print more money. And that's when we start hyperinflating. Anyways, I see Mr. Mish, who wants to give... Can't say that out loud, Mish. You're going to get me in trouble. You're going to get me shadow banned. We're not going to be reading that one on the channel. It's a family show, for crying out loud. Oh, you guys keep me on my toes. I need to read these comments to myself before I read them out loud. By the way, this is a good time. Mish is about to start chirping in my pocket and say, thank everybody who supports the channel on my Patreon channel. Thank you very much for everyone who does that. There is a link in the description to this live stream, should you want to check that out. By all means, send me your ideas, send me your comments. Everybody who sends me links and articles and headlines and theories and charts and Twitter and an email, thank you guys for everything you do for the channel. You make this better. There's just so many things that are flying around in the world at any given time, and it's hard for me to catch it all in real time. But when I wake up and I've got 5 Twitter messages about everything big that happened in the market while I was sleeping, that really cuts a lot of time out of the day. So it makes it easier on me. Thank you guys, everyone who does that. All right, China crypto. Why China crypto, says Connell McQuiston. I'll say Tether. All right, if you want to know more, you got to watch the video. It comes out in a couple of hours. But watch Tether. There's something big coming out of crypto. It's counterparty risk. And let me also just say, I still buy Bitcoin. I'm still dollar cost averaging into Bitcoin. I see the Tether story that's out there and what it could mean for crypto markets, but I'm still buying. All right, very small amounts. I don't FOMO in and pile in. My crypto approach, I have a 10-year horizon at least. I'm not going to be selling any of my crypto assets until at least 2 more halving cycles are behind us. And I learned my lesson because I was able to accurately predict the BitConnect was a Ponzi scheme back in 2018. All right, when I saw that, I saw that Carlos from New York, oh, no, video, that one. And I was like, this is obviously a scam. This is obviously a Ponzi scheme, and it's going to crash crypto markets. And I was right, and I got out in time. The problem is, by the time I got back in, Bitcoin was higher than it was when I sold it. So I would have been better off doing nothing. That's why I don't try to time crypto markets. I'm not good enough at this to time crypto markets. I just dollar cost average in. I take enough money that I don't really notice it in my weekly budget or my monthly budget, and I just buy a little bit at a time every week. It's set to automate, so I don't have to try to guess prices or anything like that. I don't have to manually enter the orders. I use an app called Swan, and it happens every week. And I'm just going to let that play out over about 10 years and see where it gets me. And the next Bitcoin halving is in 2024, and look at what has happened to the price of Bitcoin after every previous halving cycle. There's now been 3. The price rallies anywhere from 8 to 20x every time that happens. And there's 2 more halvings in the 2020s. So I don't plan on selling any of my Bitcoin until at least 2030. And if you've been following this channel for a while, you've probably heard this story before. I apologize for being repetitious, but it bears repeating, folks. 2 more halving cycles. Good Lord, you'll be wrecked by then, says Allied Master Computer. Okay. After 2 halving cycles, Mr. Allied, we can come back and see where we're at. You might be right. You might be. Maybe not. That's the next one is in 2024 sometime, and after that, 2028. My personal opinion, Bitcoin will be over $1 million by the end of that next halving cycle, that 2028 halving cycle. Again, it's just my opinion. Now, that's not to say Bitcoin is not going to go down between now and then. I think we could probably see under 20,000 again. All right. If the scenario that I described in this video coming out in a few hours plays out, Bitcoin's going under 20,000 again. And I would just keep buying a little bit every week if that happens, because it's going back higher eventually. I'm not sure we're going to have electricity in 2024, says Nicole Post. We will have electricity. It just may be a lot more expensive than we have than it is right now. All right, we are a minute away from market close. Let's see what we're doing in the close. Let's wrap this one up. We've got the S&P. Looks like it bought back a couple of points, down 55. Dow down 230 to close out the week. Again, not a great week for the Dow, but not a terrible week either. If you look at a 5-day chart, I mean, we're only down a few hundred points from where we started. So it was pretty much flat for the week. NASDAQ, on the other hand, NASDAQ had a rough week, down almost 400 points, or over 400 points. So again, I'm staying out of tech for now. I'm keeping it basic. My investment strategy remains energy, food, precious metals. And even though those are all taking a breather right now because they ran hard and fast the last few weeks, I'm just sitting pretty. Real quick, I also want to mention a couple other trades. I bought some call options in GDX and GDXJ this week, on top of the XLE and selling the ERX that I did. So I like those minor ETFs. And also, one other thing I want to mention on my live stream on Tuesday, I mentioned SIL, which is the Silver Miners ETF, and that I was looking at this one and I wasn't sure why it was still trading below its 200-day moving average when all the other miners ETFs had broken out above their 200-day moving average. And I mentioned this yesterday. I just want to point it out again. The reason why SIL has not traded well is because of this holding right here, this Polymetal International, symbol POLY, which is their second biggest holding. It's 12% of the fund. That's a Russian company that is now basically frozen because of what happened in the SWIFT system. So the fund can't sell it. They can't do anything. It's basically worthless. And it's 12.14% of the fund. So that's why ticker SIL is underperforming the other miners ETFs. So I had mentioned that I was looking at this one, but I hadn't bought it because I hadn't done a more thorough DD. And a shout out to Brian Zarb, who pointed this one out to me, that was why it was underperforming. So I'm staying out of this one for the time being. Again, it's probably got upside because I think precious metals are going much higher anyway. But I think your SILJ, your GDX, your GDXJ, they're going to outperform this one substantially if that happens. Again, precious metals, food, energy, that's where I'm at. That's where I've been in that mode pretty much since the fall. And I think that story is going to keep playing out. And I haven't yet gone short markets. I'm watching that chart on the 10-year Treasury and the MMMRI for that to tell me when it's time to short markets. And of course, when I do go short markets, I will let you guys know. I don't think we're quite there yet. All right, guys, it is 4 o'clock. The weekend is now upon us. It's been a heck of a week. I want you guys to have an awesome weekend. Again, use some of this time. Prepare yourselves. Get a little bit of food. Stash it on the side. All right, don't break the bank. Check out that video I did about how to keep it cheap. All right, there's cheap ways to get calories and protein. That's just an insurance policy and a little bit of a hedge against inflation. Don't wait for your precious metals, because if you wait until the squeeze starts, you won't be able to get them. The premiums are going to go so high and the supply will just disappear off the shelves. And enjoy yourselves. Have a good weekend, folks. All right? Enjoy these days while they're still good, because there are tough times ahead. And hey, a year from now, we may look back and wish we had it as good as we have it right now. So enjoy this time. All right, everybody. I want to thank you guys for watching. Thanks again to all my Patreon supporters. And until next time, live small and dream big.